Okay, today's bank is ConnectOne Bancorp Incorporated. It has a ticker of CNOB. It also has some preferred shares at CNOBP. They're 5.25% fixed rate. If that interests you, that could be an option. So let's see how things have done with the market price and some of the statistics here. So we can go over to ConnectOne Bancorp. You can see yesterday it had a really good day. But here we see the natural trend that we've seen for most all banks. Some of them go up right here, some of them go down right here. Looks like this one's been more of kind of an upward trend, at least over the past few weeks. So maybe gaining a little bit of traction. We've got a PE ratio of 10.5. That's about 9.5% earnings yield. That's within the average, a little bit on the lower end of the average range that we see, and also pretty average dividend yield, I suppose. So if we come over to the statistics, we can see price to book of 0.66. That's really, really low. We would typically see 0.8 to 1.05, so that's a really low price to book ratio. That's interesting. And coming down to some of the profitability metrics, we can see 0.8% on a return of assets. That's a little bit low. We typically see 0.8, 0.85 and up to about 1.05%. That's the normal average range that we see. Return on equity is also pretty low, so it almost seems like it's a pretty low, not egregiously so, but a little bit lower profitability than the average bank. And the pricing almost seems a little bit expensive on the earnings, but on its net assets it's really, really cheap. So I'm not sure what would cause the dichotomy between those two things, but once we dive in, perhaps we can get a clearer picture of what's going on. So we come down to the balance sheet. We've got about $277 million of cash. That's on the low end. It's about 2.5% or about 3% of the assets. That's pretty low. Also, the securities are about 600. When we include the equity securities, it's almost about 650 million. That's really low as well. That's about a little over 6% of the assets. So I can already see perhaps they've got, with there being such a low amount of securities and cash, maybe there's a little bit less liquidity than what we might see with most banks. The loans at 8.2 billion, that's about 84%, and that's higher than the normal range that we see for most banks as well. So it seems like they're a little more allocated toward loans than they are to the more liquid assets like securities and cash. So, but on the flip side, being more allocated to loans perhaps gives them a higher yield, and the interest income might be higher than what we see for most banks. So that could be a plus. There's always that balance that has to be met between risk and yield, right? So even though there's a bit higher allocation to loans, the leverage of the bank, so the assets divided by the equity, is about 8 times, which is a little bit lower than we typically see. So the bank might have to take on a little bit less leverage than other banks in order to make up for the lack of liquidity. And perhaps we'll learn a little bit more about that as we go through. But yeah, so based on the allocation of the loans, we might expect to see a little bit higher interest income. On the liability side, we see about 1.3 billion of non-interest bearing deposits, and that's about 15%. That's on the low end. And then they've got 73% of the liabilities and interest bearing deposits. So it seems to me that the interest expense is going to be pretty expensive as well. They've got a lot of debt as well. It looks like 11% of the liabilities. So I could see that since there's such a low amount of non-interest-bearing deposits and then a higher amount of interest-bearing deposits as well as debt, those end up being the higher cost funding sources, right? As compared to non-interest-bearing deposits, which have no cost. So it looks like maybe, even though their allocation to loans might give them a little bit higher yield, based on the structure of the liability side of the balance sheet, they're also going to have a higher interest expense. It's what I would guess just by looking at this. They've also got some preferred, which would also cut into the common shareholders' return. So 5.25% isn't too bad. It's probably about the same cost as the borrowings that they have in place currently. So, but it definitely adds to that. It's technically not interest expense, but in a way it kind of is. And we'll see how that affects the net income as well. So coming down to the income statement, we can see the interest income of about 130 million, and that comes out to about 5.69% yield on assets, and that's a pretty good yield. That's about what we've been seeing lately as we've been going through all these 10Qs, maybe a little bit on the high side of what we've been seeing. So it's a lot better than last year. As you can see, 116 versus 129. So we're getting a little bit higher yield than we did last year. And for this quarter, it's pretty good yield. Coming down to the interest expense, we can see 69 million, which represents about 3.24%. And that's a little bit on the high end as we expected, and mostly due to the interest on the deposits. So this 60 million is about 3% of assets, whereas our normal average bank has somewhere between 1.5% and 2%. So it's about double of the normal bank's interest expense, just from the deposits and as interest expense as a whole. So that's really cutting into the good amount of interest income that we've got. So then all that coming into the net interest income is about 2.45%, the 60 million. And that's a really small amount. We typically see somewhere around 3%. So 2.5% is a pretty low net interest income. So we can see that, the core of their business, which is earning a spread between the funding sources and lending it out or investing it, is not as profitable as what the average bank is. So, maybe there's a way that they can shore that up by having non-interest income or lower non-interest expense, and we can see if that's the case. So they've got about 3.8 million of non-interest income, which is really, really small. That is about 3% of the revenue. We usually see something at least 10% of the revenue being non-interest income. So that's a really small amount. I guess they don't have wealth management, insurance, or any of the other ancillary types of services banks can offer. So they're not making any money aside from the net interest income up here. So that's unfortunate. And then coming down to the non-interest expense, you can see 37 million, and that works out to about 28%, which is a really cheap non-interest expense. We're typically seeing somewhere between 40-ish to 47-ish% of revenue being the non-interest expense. So they're actually doing really well on the non-interest expense, keeping costs down. But having a lower amount of net interest income and a lower amount of non-interest income is probably going to cut into their profitability too much. And so And as we talked about the preferred dividends, we've got 1.5 million is coming out of the common shareholders' earnings in the form of preferred dividends, and so then that leaves 15.7 million for the common shareholders, which is about 0.64% return on assets when we annualize it, and that's really, really low. We typically see 0.8 to 1.05%, so we can immediately see that the bank is a lot less profitable than the average bank is, and it's mostly because they're getting squeezed on the liability side of the net interest income, and also not making any extra revenue from the non-interest income. So really putting them into a spot when they're not as profitable as we'd like to see. And so when you compare that 15.7 million to the current market cap of the bank, it results in an earnings yield of about 8.6%, which is also very low. We typically see somewhere between 9 and 11% earnings yield for the banks currently, and so this bank has 8.5%. And so it seems that not only is the bank less profitable than the average banks, but those earnings cost more than the average bank cost. So, in order for us to want to buy the earnings at that lower yield, we would want to see either a lot lower risks. So once we dive into the interest risk and the loan quality risk and then the capital risk, we would want to see all those risks as being very muted before we would want to buy earnings at such an expensive price, right? Or if there is some kind of expectation for more growth where earnings can expand and increase, then paying a higher price might make sense. But in a vacuum, just looking at this so far, we're not necessarily in the business of buying banks that don't make good money, right? So anyway, so let's keep going forward and see what the risks look like and what assessment we can make on the price based on those risks. All right, down in the footnotes, so the name of the bank is ConnectOne Bank, and they've got a lot of different subsidiaries down here. Been in business since 2005, and they've got about 24 branches, so a little on the smaller side for publicly traded banks. And I assume very geographically isolated to up in the Northeast, like New Jersey kind of area. So we can come down into the footnotes and we can see the securities here. Just like most banks, it looks like most of them are mortgage-backed securities, maybe almost about 415 million or so. And that's about 67% of the portfolio. And then they've also got some agencies here, 65 million. And that's about 10%. So really the only securities that would have any sort of credit risk, possible credit risk, would be the munis, which is only about 20% or so of the securities portfolio, and actually a really small amount of the overall assets of the bank in itself. So yeah, it's 130 million here. It's a nearly $10 billion bank, and so this 130 million doesn't add up to a whole lot based on that. So I don't think that they have an allowance on it because they consider unrealized losses in the securities, which there's a lot of them currently, but that's not uncommon for most banks, right? And they say that the losses are related to change in interest rates, so market changes, but not necessarily to credit risk. So I don't think that there's a reserve on the munis, but I feel like from a materiality standpoint, that's probably fine. And then we can see the term structure. As is common for most banks, a lot of the securities are maturing pretty far out. Looks like over 10 years from now. And then they've got the mortgage-backed securities in their own bucket because there's not necessarily a defined maturity date for those. So once we get into the MD&A at the interest rate risk side, we'll be able to look at this in more detail and also comparing it to the maturities of the loans and debt and deposits, etc. And we can make a better judgment on whether it's okay that these securities are maturing so far out, right? So let's keep going. So derivatives, they've actually got about $1 billion of cash flow hedges, and that's a pretty good amount. And the reason the items that they're hedging are the FHLB advances as well as some of the brokered deposits. So, we were talking about how they have the liability side is really, really expensive. And so I think it's a good thing that they've got all of these hedges for $1 billion to hedge the liability side from getting even more expensive. So we'll make this consideration, or we'll consider more of how effective this is once we get into more of the interest rate risk discussion. So getting into the loans, you can see the allocation of loans, and most of it is commercial real estate, $5.8 billion, and that is 70% of the loan portfolio. That's really, really high. That's basically double what we would see for most banks. And then next in line is the commercial C&I, which is about average. It's about 19% of the loan portfolio. So that's a lot of commercial real estate loans. So it'll be interesting to see some of the credit quality metrics related to these, because there is a lot of issues with various types of commercial real estate currently. So hopefully we can learn a little bit more about that right now. And also, from a regulatory standpoint, I believe there is a limit of about 300% of risk-adjusted equity. If they have more than 300% of risk-adjusted equity, common equity, within commercial real estate, I think there are things that happen that make it where their loan portfolio needs to be monitored more closely by the regulators. And they could even make steps to possibly limit dividends or other items that could be beneficial to shareholders, right? So that's something we can look at once we get into the regulatory ratio side of things. Hopefully they discuss that a little bit. So we will keep going. We can see the non-accruals are 47 million. It's a little bit on the high end. That's 0.57%. It's a little bit higher than what we would see for most banks. We've also got the credit quality indicators here. So we usually look to see what are the substandard and doubtful loans. Those would be called classified. So those are ones that have an identified weakness that makes it more likely that they will not be paid back in full, or the collateral that's in place will not cover the entire loan amount. So when we add all these together, it gets us about 55 million, and that's 0.66% of loans. That's a really small amount. We would typically, it's about half of what we would see for the typical bank. So it's interesting that, the non-accruals for commercial real estate are 36 million. And that's about how much the substandard category is for commercial real estate. So that could possibly make sense. But what's odd is, like, we would typically see the special mention be a bit more than substandard, right? Because those are the ones that, hey, these are the ones we're looking at that could potentially have problems. I feel like there should be a lot more classified in the commercial real estate. I mean, for this bank, it's got the 38.6 million is about 0.66% of loans. For most banks, we see somewhere between 1 and 2% classified loans for commercial real estate. So it seems a bit muted, and I don't know if that's because there truly is lower risk in their commercial real estate, or if these calculations are just incorrect, and maybe we can make a better assessment of that once we get into more of the non-performing loans and past dues, and reading a little bit more in the MD&A perhaps shed some light on this. I think there was recently the SEC sent them a letter asking them to better disclose the composition of their commercial real estate, so they needed to beef up their disclosures about it, and hopefully we'll get to that part as well. So as it is, this 55 million of substandard classified loans seems a little bit low in relation to most banks, and especially when we consider that they're more allocated toward commercial real estate than most banks. And commercial real estate are the ones that have a lot of the problems across the country. So yeah, we'll explore that as we keep going. So collateral dependent loans, 46 million. These are the ones that we expect will be paid off with the collateral rather than the normal pay down by the customer, right? So we can see this 33.2 comes from commercial real estate. I feel like I saw that number somewhere as well. No. Anyway, so 46.2 collateral dependent, that's about 0.55%, which is on the high end as well. It's a little bit more than what most banks have. And then we can go to the past dues. We can see the total, including the non-accrual, is about 74 million, and that's about 0.89%. So that's on the high end as well. We can see a lot of it is there's not a lot that's past due on the commercial real estate. So you could perhaps make the case that their commercial real estate is a little higher credit quality than that of most banks. Because I could see this number being a whole lot higher than most banks as far as past dues or non-accruals or classified loans. Really curious to learn what's going on there. So now we're down into the allowance for credit losses. Looks like about 83 million is the allowance, and that's about 1% of loans, and that's pretty low. Most banks will have somewhere between 1.10 and 1.26%. So I feel like that the allowance is pretty low compared to that of most banks. So that's interesting. You would think that if they're allocated to 70% of commercial real estate and they've got higher past dues and higher non-accruals, higher collateral dependent loans, they would have an allowance that either is higher than the average bank, or at least average. So they've got a reserve that's really pretty low in light of their loan portfolio having a little bit higher risks, right? So let's keep going here. Yeah, so that's the end of the part about the loans and credit risk. So once we get into MD&A, we can maybe learn a little bit more about what's going on there. So Coming down to the fair value measurements, we usually like to convert the carrying amount to fair value of the assets and liabilities. It was interesting when we were looking at the auto finance page, they had a really low price to book ratio, right? It was about 0.66%, which is a really low ratio. So now we can convert the balance sheet to fair value and see if that ratio is still pretty low. All right, so they've got available for sale securities, so those are at fair value. There's not going to be a difference there. The difference that they do have is with the loans. So it looks like that's about $270 million reduction from what's on the balance sheet to fair value. And that's about 22% of equity, which isn't that bad. We would typically see somewhere between 25 and 40% reduction to equity based on this. So perhaps the loans are either a little more short term or have closer to market interest rates currently. So that's good. And then there's a few differences in the liability side, but not that much, as is usually the case. So all that together reduces the tangible fair value of net assets, which is assets minus liabilities and taking out goodwill and intangibles. That results in about $750 million. And the market price of the bank right now is about $729. But then excluding the preferred shares puts us down a little bit more. All that together, our market to tangible fair value is about 1.13 times, which is actually a really, really good price. Most of the banks we have are somewhere between 1.5 to 2.5 times that you would pay for their tangible net assets. But this bank we're paying 1.13 times, so very cheap price for the net asset. And then from a capital adequacy standpoint, we've got about 8% tangible fair value of its net assets relative to the fair value of its assets, which is also a really great ratio. That's almost double what we would see for most banks. So it seems like they've got almost double the amount of capital than most banks do, and when we convert it to fair value, which is fantastic. It seems like that makes them a really well capitalized bank. So it seems like perhaps the net assets are at a good price and that the bank might be relatively well capitalized compared to other banks. And we'll get into more discussions of the capitalization and the pricing of the bank as we go along. But as it is, that's comforting. So let's see what else we have here. I think that might be the end of the footnotes for at least the relevant information that we wanted to know. I guess we can look at the liability side of things, so the deposits and the borrowings. So first the borrowings, we got $878 million from the FHLB. And so we've got most of it reprices within the first year, but 3.3, the 4.15%, 4.18, those are pretty low rates, I think, for the FHLB. The 5.48 is more recent rates, I believe, so a little on the higher end. They also have some subordinated debt, basically trust preferred securities, and those, I believe it's only about $5 million, so not a big concern. But they do yield higher rates just because they are floating rates, right? And so there's higher interest rates now, and so they've been repriced and adjusted up. Looks like maybe 8.43%, but there's only 5 million of them, so not too bad. And then they've also got some fixed to floating notes of 75 million, I believe. Yeah. And those will reprice in 2025 and become floating. So we've gotten maybe about a year before we start seeing higher interest rates for those. So just some things to keep in mind for our discussion of interest rate risk. So now we're getting into the MD&A. Good. we can go through these yields, but I was interested to learn a little bit more about the credit quality of the loan portfolio, so we'll get to that once we get past this. So we can see the interest earning yield is 5.63%. That's a pretty good yield currently. That's about what we've been seeing lately when we've been going through all these 10Qs for the first quarter. Comparing it to last year's rates, it would be a big increase, which is great. And so they're making a lot more interest income. As we saw, they're a little bit more allocated toward loans as well. So this 5.63% is just for interest earning assets. It's not as a percentage of all of their assets, right? So when you're looking at all of the assets, it's probably a better percentage because we're more allocated toward loans. Yeah, we can see the loan yield is about 5.82%, which is pretty average right now. We've seen some, up in the sixes lately, so pretty good average yields on the assets currently. So it's making them pretty good interest expense. Coming down into the deposits, we can see that interest-bearing deposits is getting about 3.5%. That's pretty high. Yeah, that's about double what the average bank will have been over the past year, and higher than this quarter as well. Time deposits are yielding a higher amount as well, 4.39%. The ones in our database are at about 3.5%. So they're yielding a lot higher. Time deposits here as well. And we might have skipped over it, but I think that they have a lot of brokered deposits. Yeah, so they've got about 920 million brokered deposits, it says, which isn't a really big amount, but they need to pay more for the brokered deposits. Maybe add 100 basis points or something to the yield to it, and so that eats into the yield, makes the yield higher for the deposits. And we can look at the call report, and we have to see how many brokered deposits they have, as well as how much of the deposits are uninsured. And so the call report says about 2.3 billion of brokered deposits, and that's about 31% of deposits, which is a really high amount. Most of the time we see somewhere between 4 and 7% of brokered deposits, so they have about 31% according to the call report. And that's probably a lot of what's causing the liability yields or yield on deposits to be more expensive, and it also might lead to a thought process that the bank might be having a tough time getting organic deposits, so they're having to go through brokers, which isn't necessarily a bad thing if they need the liquidity, but it's a higher cost of funding, right? So, and we did see on the balance sheet that they've only got about 14% non-interest bearing deposits, so yeah, they're having to spend a lot of money on the interest expense and the funding sources, and that's really eating into their net interest margin, which is 2.64%. It's a really low amount. We're usually looking for 3%, so. All right, so now we're getting a little bit more into the loan portfolio. Awesome. So commercial real estate about 70%. That's what we found as well. Okay, so here they've helped us out a little bit to break it out. So non-owner occupied 2.2, multifamily 2.5 billion, and owner occupied 929. All right. So in our calculations, we usually split up multifamily, and these are commercial, and then this might be more of like construction, land development type thing. So if we were to break these out to fit our statistics, let's do that right now. So okay, so by doing that, it puts the percentages more in line with what we would typically see. So, I mean, they have a whole lot more multifamily than what we would typically see. And then the loan to value ratios seem to be appropriate, right? 56%. And then, mostly allocated to New Jersey and New York. So then we can tell a little bit about the allocation to the different types. The one that's being criticized most often currently is the office space. As a lot of the offices are vacant, and it looks like 19% plus 10%. Actually, so 400 plus 98 is about 500 million of the loan portfolio is office space, which isn't too bad or out of the ordinary either. So now we talk a little bit about the ACL. So we can see it's about 1%. It's about what we calculated as well. They tell a little bit more about the asset quality. So non-performing assets of 47 million. They didn't calculate this the way that is commonly done. You would typically add the 23.6 million of 90 days and still accruing. So they're leaving out this one loan of 23.6 when most banks would add this one to the non-performing. So it makes their non-performing assets look smaller than what it normally is in comparison to other banks. And so that's all they have to say about it, I guess. So it does make me feel a little bit better that once we break out the commercial real estate loans into a little more granular categories, we can put it into how our data is currently structured, and then it makes it not be such a concentrated type in the loan portfolio. But I don't think their explanations or other information they provided us related to the ACL gives us much comfort that the ACL is okay at that lower amount. We still have a lot of non-accruals. We still have a lot of non-performing assets, still have a lot of past dues, and the reserve still is less than the average bank's reserve is. And so those two things don't match up. And as it is, we already had a bank that is less profitable than the average bank anyway. So we have a bank that's already underperforming, and then if they were to need to increase the provision a little bit more, the bank would be even further underperforming. And not only just from the bank itself, but the stock price of buying the bank, of buying its earnings, is more expensive than buying the average bank as well. So it seems like the credit risk of the bank is too high, and the price that we're willing to pay for it is lower than what the price is currently. Like, if the price of the bank was a lot lower, to a point where increasing the provision would be okay to us, we would still be making good money, then that would be fine. But in this case, they're already underperforming and at a price that's too high, and so more credit issues and provisions would exacerbate that farther, and that's not a risk that I want to take. So if we keep going here, so interest rate sensitivity analysis, we have the normal table that we typically see where, if interest rates go up 300, 200, 100 basis points, or down 100, 200, 300 basis points, what happens to the net interest income? And so it says that, if interest rates go up, then net interest income goes down, and vice versa. And so that's a liability sensitive balance sheet, right? And I think we already have made some points about that, and the bank is already a lower net interest income bank compared to other banks. And so we have a risk here that if interest rates go up further, they're going to be even lower risk, right? Or even lower profitability. And so I prefer the banks to be a little bit on the assets sensitive side, because banks are naturally liability sensitive over a long period of time, right? But also, we already know that the bank has a large amount of broker deposits, although they are hedging them by about $1 billion, right, which we saw. So that's helpful, but also a lot of their debt reprices really quickly. As we saw, most of the FHLB borrowings reprice within the next year. The fixed to floating rate securities reprice in 2025, and only 14% of the liability side is non-interest bearing. So they have a lot of debt and deposits that reprice really quickly and that are already at fairly high rates. So this is a big risk. If interest rates go up, their net interest income is going to get squeezed even farther, and their net interest income is already pretty low anyway. So I don't like the interest rate risk. And if you were to look at the call report, you would see that basically 81% of the securities reprice 15 years from now. So they're locked into these really low rates for at least 15 years, 80% of them. And if you add in the ones that reprice 5 to 15 years from now, that's 16%. So basically, about 97% of the securities reprice at least 5 years from now, and they're at really low interest rates compared, to historically. So that's a big risk that they're trapped into that on the asset side. And regarding loans, only about 27% of the loans reprice within the next year, and we would typically see somewhere at least in the 30% of the loans reprice. So they're also locked into these interest rates for these loans for at least another year as well. So there's not a whole lot of help from the loan portfolio to shore up some of the repricing risk that's apparent in the securities portfolio. And then from the liability side, I think we talked about as well, almost all the liabilities reprice within the next year, and only 14% are non-interest bearing. So that would be the only protection, is if they had a lot more that was non-interest bearing. So, and they're already at pretty high yields, so that's just a lot of risk in the net interest income. And the market price for the bank's earnings is already too high, and the net income of the bank is already too low. So that's a risk that we're not willing to take either. From a liquidity standpoint, we already saw that they've got less cash than most banks have. They have less securities than most banks have, and they're a lot more allocated toward loans, which is less liquid type of asset as well. So if we're looking at on-balance sheet liquidity, with the low amount of cash and the low amount of securities, comparing that to the deposits, it's about 9%. So that's pretty low. We typically see somewhere between 12 and 18% of on-balance sheet liquidity to deposits. So they've got a pretty low amount of on-balance sheet liquidity. Of course, they've also pledged a lot of assets to the FHLB and the Federal Reserve, and that gives them the ability to borrow more if they need to, right? So they have about 33% of their securities pledged and about 73% of their loans pledged. So that gives them some more capital were they to need it, right? And that puts them about 74% of deposits. Once we add in the amount that they can borrow from the FHLB and the Federal Reserve, it's about 74% of deposits, which is about average. So, even though they might not have adequate on-balance sheet liquidity, they do have some off-balance sheet liquidity they can draw from if they need to. But if they do that, that's going to be at higher rates and higher yields, I think, than what they're currently paying on their current balance sheet, right? So I could see that they don't have a lot of securities that are repricing or maturing within the next year. We saw that the loans that don't necessarily mature or reprice as quickly as most banks either. And so with them having a lower amount of on-balance sheet liquidity, I could see that they could possibly have to borrow more from the FHLB, get more brokered deposits, something like that, which would be even higher interest costs, right? So I do think that there is a little bit of risk there. I wanted to come down, so regulatory capital. Since we're talking about capital, so we got all the regulatory ratios here, 10.7, 10.7, 12, 13. So some of these ratios are a little bit lower than average, and some of them are kind of within the average. I think the preferred shares help them out for the ones that are like total capital type of thing, but the ones that are common equity might not be as robust, and so a little bit lower capital ratios, but they're not below the range that the regulators require. So there's not an issue of being prevented from paying dividends or being prevented from merging or doing major transactions like that, right? But we do see that the regulatory ratios, the risk-based capital ratios, are perhaps a little bit lower than what we would normally see, and that might be because they're a little bit more allocated toward commercial real estate, which get dinged a little bit more for the risk adjustment. They don't really mention if you remember, I was wondering about the 300% rule of commercial real estate relative to risk-adjusted capital. They don't mention it here, so perhaps it's not relevant. At least I hope. So anyway, it seems like they probably have an adequate amount of capital in place to be able to continue as a going concern. And there's just the risk that since they have a little bit less liquidity, then they might need to borrow a little bit more from other sources, and that could reduce the net interest income a little bit. But I think that gets us down to the bottom. So let's try to summarize all this together. I think you already know the direction that I'm leaning toward this. And so we already saw that the bank is not very profitable. It has a lower profitability than the average bank. I think 0.66% return on assets, which is really, really low. And it's mostly due to the net interest income getting squeezed from having such high costs of its funding sources, right? They have a lot of brokered deposits, which are more expensive than organic deposits. They also have not very much non-interest bearing deposits, which come with zero cost, right? So all those things are making their interest expense be really high relative to that of the average bank, which is squeezing their net interest margin. And then they also don't have very much revenue coming from ancillary services such as wealth management or insurance, things like that. So it makes it to where they're not making some extra money that could be easy to be made, right? And so that makes their net income be really, really small compared to most banks. And from a pricing standpoint, the price on those earnings gives us like a 8.3% earnings yield, somewhere around there, which is a really low yield. If we were to buy the bank, we would be earning a smaller amount than the average bank as far as earnings go. So, already it doesn't seem like a good bank to buy unless there's really, really muted risks or a lot of growth in the earnings that we could expect, right? But as we went through everything, we found that that's not the case, right? So thinking of the loan quality risk, we saw that they have a lot of past dues, they have a lot of non-accruals, they have a lot of non-performing loans, at least more than the average bank does, right? But they have a smaller reserve than the average bank does. So those two things don't connect. So there is the risk that in the future they might have to increase their reserve to catch up what they haven't reserved for already, and that would hit the income statement, right? And we don't know how that will turn out. We can't predict the future. It just seems like that there is a risk for that, and we would like to be compensated for that risk by having a lower stock price. So already the stock price is high for the earnings, and adding in the risk that the earnings could need to decrease even further makes the price be even more expensive for our future risk adjusted earnings, right? So that's the credit risk. We also have the interest rate risk, which we saw they're a little bit on the liability sensitive side. So not a whole lot of their securities reprice even within the next 15 years. Not as much loans reprice within the next year as we normally see either. So there's within the next year there's a risk that most all of their liabilities reprice at higher rates, and they don't have a whole lot of non-interest bearing deposits. So I could see them getting squeezed as not a lot of the assets reprice, but almost all of their liabilities reprice. And so it's squeezing that spread that is already too small, right? I think the spread was 2.64%, 2.66% net interest margin. So if the liabilities interest expense increases and the asset side doesn't move, they get squeezed. And so then that net interest margin goes down even further, and the bank makes even less money. And we saw that the liability side has already high funding costs, so it will make those costs even higher. With the brokered deposits as well as FHLB borrowings and that type of thing that will reprice within the next year. So, and then from the capital side, we saw they've got a little bit less liquidity than we typically see. We got a little bit less cash, a little bit less securities, a little bit less on balance sheet liquidity, right? I think it was about 9% of deposits. But the off balance sheet liquidity, they're able to borrow some more from the FHLB, borrow some from the Federal Reserve perhaps, and that puts them in a position where if they needed to get some capital, they could, right? But that would come at a higher cost, right? So there is that risk that they might not have enough on balance sheet liquidity and will have to go outside the bank and borrow some, and so that will cost them some interest expense at the higher rates, right? So all those, the credit quality risk plus the interest repricing risk as well as the capital risk all come together and make it to where the bank already has lower earnings, but those risks make it to where there could be a possibility that the bank could have even lower earnings soon. And for that, we would want to pay a lower price for the bank. But as it is, the price for the bank is already too expensive on just the earnings without taking into consideration the risk, right? So I hope I made that make sense. It is interesting though that the price on the net assets of the bank was super cheap. I think 1.13 times their net value. So I could see a stronger bank that has cheaper funding sources could buy this one, getting the net assets for pretty cheap. And then if they restructure its balance sheet to pay off all the highly expensive liability side and using its own funds and capital to have cheaper funding sources, they could make the bank be fairly profitable, right? And be a high performing bank. But as it is now, as an individual, very small allocation shareholder to the bank, that's the bank itself has too many risks and not enough profit, and the price being too high for those things. So anyway, that's my analysis and conclusion. If there's anything else that you'd like to add or ask, definitely leave comments or email me or send me a message, whatever. I'd love to hear what you had to think about it and what you thought about my analysis and whether I'm on the right track or you disagree. Definitely let me know. So thank you for listening.